Hi everyone, very good morning and welcome back to Crack Grade B. So today we are going to start the EPFO related questions. Those have been asked in the previous year examinations, right? So today's session is going to be all about the questions that have been asked in the year 2021. Number of questions are less, but the concept wise these questions are important. Fine. So we'll be discussing the solutions in detail. We'll be also discussing the options, that what options have been provided and what should be there, what should not be there. Okay, so with that, let's start. Previous year questions 2021 of those have been asked in the UPSC EPFO examination. Question number 1. And I would like that you guys also answer wherever you think that okay, this might be the answer. And it's all about, see, I'm guessing that you might be knowing some of the concepts of accounts, right? So with that, let's start. The question number 1 is, which one of the following concept is applied by an entity when events such as new competitors entering into the market and there is a rift between production and marketing department? It is not disclosed in the books of accounts. When such kind of transactions, if they are not disclosed in the books of accounts, then the question is asking which kind of concept the organization is following. Let's see what kind of concepts have been provided to us. Matching, money measurement, revenue recognition and cost concept. So the correct answer over here is, if you carefully see the transactions, number 1 transaction, it is given events like new competitor has entered into the market. New competitor has entered into the market means this is not having any kind of monetary impact on the organization. Or you can also say it that organization is not able to measure the monetary concept of this particular transaction. Fine. The monetary impact is not measurable. Along with that, there is a rift between production and marketing department. This kind of transaction, what they are saying is that such kind of rift, we cannot measure this in terms of money. Therefore, what is going to happen? We have not recorded these particular transactions in books of accounts because we cannot measure them in terms of money. So the concept which is being applied over here is money measurement concept. Fine. Money measurement concept says that you are going to record all such transactions into your books of accounts which are having a monetary impact onto your organization. Fine, easy concept. And these two of the transactions, they were not having really any kind of impact, and versus organization was not able to measure the impact that it was having. Fine, so hence this was not recorded. Now let also see what are the other options given. Matching concept is given, revenue recognition is given, cost concept is given. So cost, so we can understand what is revenue recognition. Revenue recognition means, suppose if you have done any sales, fine, if you have done any sales, then at what point of time you should take this particular sales into your books of accounts. This is called as the revenue recognition. The timing of recognizing your revenue, this is all what deals with the revenue recognition concept. And then we have matching concept. Matching concept says that whatever your expenses are, your expenses as well as incomes which are belonging to a certain year, they should be recorded into that. For every expense, the revenue should also be recorded side by side, and for every revenue, the cost should also be recorded side by side. So this was our question number 1. Now next question. Next question asks us that which one of the following denotes gross profit. So when we were reading the accounts, we have discussed various number of times the gross profit meaning, but let me discuss it once again. Fine. So there are two concepts that you must be knowing about. Number 1 is what is cost of goods sold. So the formula of cost of goods sold is like this. I'm writing in short COGS, that is cost of goods sold. It is calculated opening stock plus purchases that you have made in the year plus direct expenses and minus the closing stock. This is the formula of cost of goods sold. This is how we calculate the COGS. And once we have calculated the cost, the formula of gross profit goes like this. So your gross profit is equal to sales less cost of goods sold. This should be like that, right? Whatever revenue you have earned during the year, you are going to deduct the amount of expenses you have incurred in order to produce it. So sales minus COGS is the correct answer, and this is how gross profit is denoted. Now let us look on the other options as well. What other options are saying? Cost of goods sold plus opening stock. Now if you see, if you already know the COGS formula, the formula of cost of goods sold, you are going to witness that opening stock plus purchases plus direct expenses less closing stock. This is the formation of your cost of goods sold, right? So why we will be adding again opening stock in order to find out the gross profit? So this is totally wrong option. Next is sales less purchases. So we have to understand, we just not only have to deduct the purchases. There are so many other expenses as well. Those are incurred in order to produce the output. So we have to add them as well. The direct expenses like carriage, etc. we have to add them. Apart from that, opening stock, closing stock and direct expenses, the wages also become part of it, because in order to make any particular product you have to incur wages onto it. You must have purchased the raw material, but at the end of the day, in order to convert them, wages needs to be incurred. Plus the difference between opening and closing stock, they are also forming the part of your cost of goods sold. So the second option is also wrong one. Then the third option, net profit less expenses of the period. Yeah, we can go through this route also, right? We can go through this route also, but they are missing something over here. What they are missing? Net profit less expenses of the period. Great, but you also have to add indirect incomes. Wait, you have to deduct indirect incomes and you have to add back the indirect expenses. So this would have been the correct formula in order to reach the gross profit, right? So this is how we can find out, although this much analysis was also not needed if you already knew the formula, that is sales minus COGS, and you would have been identified it that what is the correct option. Now moving on to the question number 3. Question number 3 asks me that what is the underlying concept that supports no anticipation of profit but provision of all possible losses. There is a concept which says to every business that if you're thinking that any income is coming, please do not recognize it until and unless you are very sure about it. For that, we have a different concept called as the revenue recognition. That is separate. But this concept says that if you see that okay, some loss is going to be incurred, please record that particular loss into your books. Fine, please provide for it. So if you know, if you must be knowing that we do create provisions into our books, right? Provisions are created into the books, and why these provisions are created? We are making some space for the losses which might be incurred to us in the future, right? So what concept is this? Matching concept, materiality concept, consistency concept, or conservatism? So let me tell you, matching concept we have already discussed. Materiality concept says that you have to record the material items separately. Fine. We will be discussing about this in detail also when we will be covering the core in the accounts in the EPFO course. Consistency principle means the accounting policies, accounting principles should be applied consistently one period from the other period. I repeat what I am saying. Accounting principles, accounting rules and regulations, they should be applied from one period to the other period consistently. So that is the lookout of consistency principle. So now we are left with just one option, and that is the conservatism. Right? This is called as a conservatism option. Conservatism says that you have to provide for all the possible losses. Being conservative means we are in normal parlance also we use the word you are very conservative. Conservative means you are with some backward thought of mind. You are not progressive. You are having a regressive set of mind. That is what we call a person to whom we want to address as conservative, right? So the principle of conservatism also says that forget about the incomes, record all the losses, whether they have been incurred. Obviously, if they have been incurred, you have to record them. And even if there is a future probability that they are going to be incurred, then please record into your books of accounts. And how do we record them? We make provisions. For example, we can take example of provision for doubtful debts. So we know that in our business we have debtors. Debtors are the persons from whom we have to collect the amount. We have made sales to them, and that is why we have to collect amount. But always this is the case that they might not pay us the amount. There might be certain people who might default, right? So for such kind of people, based on our previous experiences, we do create provisions for doubtful debts, and this is what the conservatism principle calls for. Okay. Now next question. The next question asks for that which of the following concerns prepare the receipts and payments account: trading, non-trading, manufacturing, companies registered under the Companies Act. Now if you see, the options are quite close ones, right? Manufacturing entities, those who are manufacturing something. Trading entities means these are not manufacturing, they are just buying and then selling. Fine. And companies who are registered under Companies Act. So manufacturing concerns can also be registered. Trading concerns can also be registered under the Companies Act. Fine. Non-trading concerns can also be registered under the Companies Act. I have told you non-trading concerns means what we mean to say over here: organizations like non-for-profit organizations. Correct. Those who work for the welfare purpose, they do not have the intention of making profits. Profit making is never their intention. They just want to do the welfare. I hope that you might be knowing many of such kind of organizations, right? So these are called as non-trading concerns. Now, for all those people who know the basics of accounting, they must be knowing that the companies registered under Companies Act, manufacturing organizations, trading concerns, they are primarily preparing such kind of accounts. See, they do prepare trial balance. Trial balance is must. Then they prepare P&L account, right? And after that they prepare balance sheet. We normally do not hear that receipts and payment accounts are maintained by such trading and manufacturing concerns. Why is the case? Because I'll tell you, these non-trading concerns, or I can also call them as not-for-profit concerns, who are operating for the welfare objectives, they prepare the receipts and payments account. right? Why they have to prepare? Because see, they take the donations from different individuals. They take the funding, they take the donations from different set of individuals, and that is why they also have to show that what is the receipt that they have got and how they have utilized the funds out of it. So therefore, preparation of receipts and payments account becomes crucial for such organizations called as a non-trading concerns, right? So all of these three, trading, manufacturing, non-trading, all three, they get registered under the Companies Act. So the option of companies registered under Companies Act, you could have just totally ignored it. Now next question is, which one of the following statement is correct about income and expenditure account? So we have been provided with four options. It is a real account, personal account, nominal account, or representative personal account. Fine. So I'll tell the difference between these. For example, real account means they are represented by the assets year on year. Personal account is self-explanatory, no need to explain that. Real account means depicted by the machineries which are real, which are going to exist year on year, correct? And what are your nominal accounts? So nominal accounts, they generally get closed within a year. Within a year, such kind of accounts are like your expenses, your incomes. Suppose dividend received, this is an account, fine. Interest, this is an expense. What else we have in form of expense? Salary, right? So such kind of accounts which are made for a year and then they get closed at the end of year. How do they get closed at the end of year? That is a big discussion and we'll be doing when we'll be covering the EPFO syllabus. But as of now, just understand that yes, they will receive like any kind of your incomes or your expenses account. They are called as a nominal account, right? Wherever representative personal account, suppose you had to pay the salary, but you were not able to pay the salary to some of your employees. Now this salary has become outstanding, correct? So now the account's name will be like this: salary outstanding account, right? Outstanding salary account, you can pronounce it in whichever way. Now just see very carefully. Salary account alone, I would have called it as a nominal account. But as soon as it has become outstanding, or suppose it has become prepaid, now this account is representing a person. The salary is outstanding because I have to make a payment to someone, correct? So now this account is representing some individuals and that is why it is taken as a representative personal account. Understood? Whenever your account is representing someone, we call it as personal account. But yes, here if your nominal accounts, they become prepaid or they become outstanding, in that particular case they start representing a person to whom which we have to make the payment or we have to receive the payment. That is why they are called as a representative personal account. Fine. So income and expenditure account, it is a nominal account. Fine. It is a nominal account. I have already told you the discussion onto it. We have discussed it. Now next is wages paid for installation of machinery is debited to which one of the following account? Which one of the following account? Wages account, machinery account, installation account, P&L account. Just wait for a second and give me the answer of this particular question. Yes. So the four options that has been provided to you are wages, machinery, installation account and P&L account. Fine. The question asks that wages paid for installation of machinery. So I'll tell you a concept over here. What is the concept? So whenever you are bringing a new machinery, or let's say you are building a new machinery, in that particular case you have to determine that on which day the machinery is put to use. Fine. Day on which machinery is put to use. So the day installation is finished, now your machinery is ready to use. Fine, ready to use, put to use. Now whatever expenses that have been incurred before it, whatever expenses that have been incurred before this, that means till your machinery is not ready, they will be debited in machinery. Why is it so? I'm going to tell you that as well. And any expense that you incur once your machinery is put to use, they are going to be charged to P&L account. Fine. So till the time your machinery is not ready, please debit all the expenses that you have incurred in order to construct that particular machinery. They are going to be debited in machinery account. Now what is the meaning of debited in machinery account? Suppose I purchased a machinery for 1 lakh. 20,000 rupees I have incurred. I have purchased from the supplier machinery for 1 lakh. 20,000 rupees have been incurred on the installation, that means labor, etc., and some other installation expenses. Apart from that, 5,000 also paid on the amount that I have borrowed as a interest. I did not have the total 1 lakh rupees, so I borrowed it from someone and that person has charged me 5,000 rupees. This 5,000 rupees are pertaining to the period before which I have put the machinery to use. So I am going to add all these expenses. That means I am going to debit all these expenses in the machinery account. Fine. So now machinery will be having the worth of 1,25,000 for me. Understood? This is the concept. And now suppose after machinery is put to use, after I have started using it, suppose repair expenses comes in. I have to get the machinery repaired. So such kind of expenses, they will be charged to the your P&L account. Fine. So the correct answer over here is machinery account, not wages account. Fine, not installation account and not P&L account. I hope you must have understood this. Next is, when are the current liabilities payable? We have the options: within a year, after 1 year, but within 5 years, within 5 years and subject to a contingency. So this is such a easy question. I do not think that you might be getting any easier question than this. Fine. So under this current liabilities, we all know that all such liabilities which are payable within a year. All such liabilities which are payable within a year, they are classified as current liabilities. There is no such concept of 5 years, right? There is no such concept of 5 years. So this is the correct answer. Subject to contingency. So such liabilities, we call them as contingent liabilities. Suppose, for example, a court case is going on against my company. A court case is going on against my company and I do not know that what will be the outcome of that particular case. I do not know about it. So this is called as the contingent liability, where I am not aware about the outcome. I might have to pay the liability, I might not have to pay the liability. So this is called as contingent liabilities, which are needed to be paid on the basis of contingency, and current liabilities, they are payable within a year. Next is Is the total of debit and credit side of trial balance are same? Then the answer is no. There are sometimes good reasons that they differ. Yes, always. Yes, except where trial balance is extracted at year end, and no, because it is not a balance sheet. Now these are the options. These are very easy questions, let me say, because they are very conceptual in nature. If you have understood the accounting, if you have learned it, then you would have, it would have been an easy guess or easy answer. Trial balance, what is there in trial balance, I'll tell you. Let's first discuss the process, okay? So whenever something happens in my business, or whenever I have to pass any entry, the primary book that I have is called as the journal. First of all, I prepare the entry in my journal book. I pass the journal entry, right? Once I have passed the journal entry, the next step is that ledgers are prepared. Suppose I have made the payment to someone for salary, right? So the entry will be salary account debit to cash account. I have paid it, right? So this is called as the journal entry. Once I have prepared journal entry, now the ledgers will be prepared. Ledgers means salary account ledger will be prepared. All such entries which have been passed in the salary account, we are going to depict it separately. So this is your number 2 step. Number 3 is your trial balance. So we take the closing balances of all such ledgers. Salary account, cash account, purchase account, sales account, etc. etc. We take closing balances of all such ledgers and we show it into the trial balance, right? So trial balance is sum total of the closing ledger balances. Once trial balance is prepared, from the help of trial balance, we prepare P&L and then we also prepare balance sheet. Fine. So this is the flow, how the things work over here. And always know the trial balances figure, they are having debit balances and credit balances and they are always going to match. Fine. So this is the answer. Trial balance, the both sides of debit and credit, they are going to match always. Now the options that have been given for the confusion creation, let us see them as well. So except where trial balance is extracted at year end, what is this point? We always extract, we always prepare the trial balance at the year end. Fine, we take all the ledger balances, whatever has happened during the time period, and that is when we take it. So this is not a correct option. Sometimes good reason, obviously no to not applicable. Okay, so debit and credit side of trial balance. Next is, which one of the following is the first book in which transactions of business unit are recorded? Now first book, if you see, I have already told you the process: journal, then ledger, then trial balance, and with the help of trial balance we prepare the P&L and balance sheet. So yes, the four options have been provided to you: journal, ledger, cash book, balance sheet. Balance sheet is the final outcome. Yes, Soumya, correct. So the journal is the primary book where you record your business entities, whatever transaction, the first transaction. Suppose I have made a payment to someone, I have done sales. So first thing I am going to record in the journal and then the process follows later on. And the last question that we have is, which one of the following statement about trial balance is correct? It is a book containing different accounts of an entity. Okay. It is a statement which contains balances of debtors. It is a statement which contains balances of debtors and creditors. And it is a statement which contains various ledger balances of an entity on a particular date. Now, if we see in this, the option B and C are totally wrong. they have limited the scope of trial balance. They are saying that trial balance just contains the balance of debtors. Option B says it, and option C says that trial balance just contains the balances of the debtors and creditors. Both are wrong. Trial balance contains the balances of ledger accounts, all ledger accounts, right? So that is a book which contains different accounts of an entity. Now we are confused between option A and option D. But see, option D says it is a statement, which it actually is. Contains the various ledger balances. This is the correct interpretation of trial balance. We do not just contain the different accounts. What we contain is the closing ledger balances. What is the closing ledger balance of sales account? What is the closing ledger balance of purchase account, interest account, salary account, etc., etc. So option number D is correct. Fine. So these have been the questions that were asked in the year 2021 of UPSC EPFO examination pertaining to the accounts section that we have discussed today. In our next section, I will be discussing more of the questions from many previous years, right? So if you did like this video, do not forget to give us a thumbs up, and also if after watching this particular lecture, if some of the contents you must not have been able to understand, then please let me know that as well. So I will incorporate that into my next lecture. Fine. Thank you so much for joining in, and this is it for this particular session. Do not forget to post your queries below the video if you find any particular queries. I have tried my best to explain all the terms as well as whatever has been used concept wise also. But still, even if you have not understood a slightest of point, then you can just drop a comment. Thank you.